Hi and welcome to Swiss Codes Daily Market Talk. It's Monday, June 16th. Oil markets jumped open the week after a weekend of attacks between Israel and Iran, yet the initial jump in oil prices was rather countered by strong selling despite the mounting tensions in the Middle East. So, mood across risk assets is surprisingly okay this morning when considering the ugly geopolitics of the latest days. So we will talk about all that, and we will also talk about the upcoming Fed, BOJ, Bank of England, and Swiss National Bank decisions. But before we do, please keep in mind that opinions are my own and this is not financial advice. So headlines were busy this weekend as attacks between Iran and Israel continued. An Iranian gas field in the Persian Gulf was hit on Saturday, hinting that the escalation could actually lead to further jitters in the energy markets. Now, even though the hit to this particular gas field in Iran shouldn't do damage beyond the Iranian domestic market, the gas processing facilities in Iran are also linked to offshore oil production sites and could eventually disrupt international energy flows, it is said. So the US crude jumped open the week above the $76 per barrel level, while Brent crude traded past the $74 per barrel mark. But interestingly, gains were rapidly given back in these markets. Nat gas prices also jumped past the 100-day moving average at the open as a result, but also giving back the gains interestingly, while the US dollar is slightly stronger on haven flows, whereas gold is giving back gains after opening near record levels. So the early hours of the new trading week suggest a surprisingly muted market reaction to the darkening geopolitics of the Middle East. Some actually argue that the mounting tensions in the Middle East between Iran and Israel could weigh on global growth outlook, global growth prospects, hence limit oil's upside potential. Others bet that the rising oil prices of the moment could somehow encourage shale producers to pump more oil and limit the rally in oil prices. But more realistically speaking, we could actually see disruptions in oil and gas flows in the Strait of Hormuz if things get worse. Therefore, risks remain tilted to the upside in energy prices. Now, many experts out there say that this time, tensions between Israel and Iran look worse than they did over the past few years, and many of them suggest that widening conflict in the Middle East could actually send oil prices above the $100 per barrel psychological level, given that a third of the world's oil production comes from the region. So let's see who between analysts and traders will be right. But for now, oil prices are still contained and they have not been able to push higher on weekend tensions. Now, in equities, the European futures are slightly lower in Asia this morning, while US futures are slightly higher after Friday's over 1% sell-off in the S&P 500 on rising Middle East tensions, obviously. So energy stocks in the S&P 500 were among the biggest gainers of Friday's trading session, of course, but they could eventually give a part of the recent gains as oil prices actually refused to push higher this morning on the back of mounting geopolitical tensions in the Middle East. Elsewhere, well, Visa and MasterCard actually tumbled on Friday between 4.5% and 5% on reports that Walmart and Amazon are exploring the possibility of launching their own stable coins to reduce costs, but also to reduce delays to payment transactions. So that would be a milestone for the coin market, obviously, as the latter could also extend to funding opportunities for these big retailers, where corporations would actually seek funding by selling tokens rather than selling bonds or equities like it has been the case in the traditional market. So that would be a cheaper financing opportunity for them as well. So that's a space to watch for the future of crypto assets and tokens. But back to the traditional space this morning, Nikkei is up by almost 1% at the time I'm talking here this morning, partly thanks to a weaker Japanese yen, and on news that Japan and the European Union could eventually cooperate for strengthening their defense industries. So the European defense stocks remain obviously interesting in the middle of rising geopolitical tensions and also due to an uncertain US military support moving forward, while equities in China struggled this morning on the back of mixed economic data released earlier this week. In one hand, growth of Chinese retail sales unexpectedly accelerated in May, printing a solid 6.4% expansion last month versus less than 5% expected by analysts. That was good news, but investments and production data came in softer than expected, and that was probably due to the tariff situation and export slowdown due to higher tariffs. So Hang Seng retreated below the 24,000 level this Monday, and appetite is quite limited. Now this week, investors will continue to watch the Middle East developments and energy prices, obviously, along with the Federal Reserve, Bank of England, Swiss National Bank, and Bank of Japan monetary policy decisions. So on Tuesday, the Bank of Japan is expected to maintain its policy rate unchanged and potentially slow the pace of tapering its asset purchases in response to mounting trade and geopolitical tensions worldwide, and also to avoid a further meltdown in the Japanese sovereign markets. Because remember, the Japanese long maturity yields have hit scary levels back in the month of May, and that somehow encouraged Japanese officials to consider the market dynamics to follow up with their policy decisions to obviously avoid a broader market mayhem in Japan and beyond Japan. So a sufficiently dovish stance from the Bank of Japan this week could eventually slow the Japanese yen's appreciation, throw a floor under the dollar-yen, release pressure on the Japanese bonds, especially on the long maturity bonds, and support the Nikkei stocks. And easing pressure on the Japanese yields is also good news for the international markets, mind you, as a potential reverse carry trades in yen is obviously a risk to global equity. So happily, many investors now think that the Bank of Japan will not announce its next rate hike before the first quarter of next year. On Wednesday then, the Federal Reserve is also expected to maintain its own rates unchanged and will probably not consider cutting its interest rates anytime before its September meeting. And note that the Federal Reserve officials will probably want to wait and see what will happen on the tariff front, on the tariff negotiations, and how the outcome could impact price levels in America. And the resilient jobs data gives the Federal Reserve time to just sit and wait on their hands. Data-wise, we've also seen the largest jump in the University of Michigan's Consumer Sentiment Index in June last Friday. So that means that tariffs, uncertainties, mass deportations, street protests against these mass deportations, army in the streets of LA, geopolitical tensions worldwide, all that look peanuts to US consumers. They are apparently doing just fine. Then, on Thursday, the Bank of England will also announce its latest monetary policy decision and is expected to remain seated on its hands as well, despite rising worries in the UK regarding the British economic outlook amid the British government's expensive fiscal measures that's weighing on the growth outlook in the country, while the Swiss National Bank is expected to bring its own policy rate to 0% this week to counter the Swiss franc's strength and hope to give relief to Swiss economy that's also under the shadow and the pressure of the trade uncertainties with the United States. So the Swiss companies face more than 30% tariffs, remember, if the two countries, the US and Switzerland, cannot reach a trade deal in time, and no deal has been reached so far. So the post-April 2nd rebound in Swiss equities and the SMI index remain somehow softer than the European peers, as the index recovered around 2/3 of the March to April sell-off, and that despite the broad expectation that the SNB will be cutting its rates to 0% this month. So this means that the uncertain trade situation with the US and the Swiss franc strength are weighing heavily on the Swiss markets and on the Swiss market valuations, and a rate cut from the SNB may not boost appetite unless trade situation improves and the Swiss franc softens. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.